Fixed income markets, issuance, trading, and funding. This reading is essentially about the structure of the fixed income market, and you might wonder why it is so important to understand how the fixed income market is structured. And the reason can be seen over here based on numbers. The total global debt in 2021 is approximately $281 trillion. So that's a huge amount. And to put this in context, as a share of global GDP, this is approximately 356%. So the point is that the debt market is very large, and therefore it makes sense to understand how the debt market is structured. And this is important both for issuers of debt as well as investors. Now, specifically, in this reading, we'll talk about the classification of fixed income markets. So obviously, fixed income is a larger term, but within fixed income, there are different types of fixed income markets. We'll talk about primary and secondary bond markets. We'll talk about sovereign bonds. These are bonds that are issued by sovereign governments. Then we have non-sovereign government debt or non-sovereign government bonds, quasi-government bonds, and supranational bonds. So non-sovereign government bonds might be issued by states or provinces or government entities. Supranational bonds are issued by entities that span nations. So for example, entities like the IMF or World Bank. Then we have corporate debt. This is debt issued by corporations. We have structured financial instruments, so we'll understand the market related to these instruments. We'll talk about short-term funding alternatives available to banks. And then the final segment of this reading has to do with repurchase and reverse repurchase agreements. And the term commonly used here is repos and reverse repos. Section 2 has 3 subsections: the classification of fixed income markets, a few words on fixed income indices, and the sorts of investors who invest in fixed income securities. Classification of fixed income markets. One way of classifying bonds or fixed income markets is by the type of issuer. We can have bonds which are issued by federal governments. Those are called sovereign bonds. We can have bonds which have been issued by state governments, bonds which are issued by organizations such as the IMF and World Bank. Those bonds are called supranational bonds. We can have corporate bonds. These are bonds that are issued by corporations. Another categorization is credit quality. Here, bonds are separated based on their quality. Bond ratings are provided by agencies such as S&P, Moody's, and Fitch. And we can have a category of bonds which have a very high rating, such as a AAA rating. They can be bonds with BBB rating. This is material that you will see in a lot of detail later when we talk about credit analysis. Bonds with ratings of BBB and better are generally referred to as investment grade bonds. Bonds with a rating below a certain level are referred to as junk bonds. Again, more on this later. Next, we talk about maturity. This is another way of categorizing bonds. We can have bonds with maturities of less than 1 year, bonds with maturities of 1 year to 2 years, and so on. So maturity is another way of categorizing bonds. Currency denomination. Bonds can be categorized based on the currency in which they are denominated. Most bonds are either denominated in US dollars or in euro. This is important. The type of coupon. Broadly speaking, bonds will either pay a fixed rate coupon or a floating rate. And we've seen this in the previous reading, but very simplistically, a fixed rate bond or a fixed rate coupon is one where the rate is fixed. So a simple example would be a coupon rate of 6%, and the coupon payment would then be the coupon rate multiplied by the par value of the bond. With a floating rate, the coupon payment for a given period is calculated as the reference rate at the start of the period multiplied by the par value. Now, the reference rate that is generally used is an interbank offer rate. The reference rate could be different. It could be the prime rate in a country, or it could be the T-bill rate, but the interbank offer rate is what is generally used. It is important for you to understand the definition of the interbank rate. Interbank offered rates are a set of rates that reflect the rates at which banks believe they could borrow unsecured funds from other banks in the interbank market for different currencies and different maturities. The most commonly used interbank rate is the London interbank offer rate. The currency here is the dollar, and if you look at the financial newspaper, you will notice different LIBORs. There will be a 30-day LIBOR, 60-day LIBOR, 90-day LIBOR, and so on. So notice the different maturities. Bonds can also be classified based on geography. So we can have American bonds, for example. We could have Chinese bonds. In the American market, we will have domestic bonds and foreign bonds. Domestic bonds are bonds issued by American companies, and these bonds are traded in America. Foreign bonds in the American market are bonds which have been issued by foreign countries but are traded in America. And then we also have Euro bonds, which are not tied to a particular country. And hopefully this sounds very familiar because we have talked about this in the previous reading. There can be other classifications as well. For example, there might be a category of bonds which are tax exempt. So we can say one classification is tax exempt bonds versus bonds which are not tax exempt. Let's take a look at example 1 now. Which of the following is most likely an issuer of bonds? Hedge funds and pension funds, these are actually investors. So hedge funds might buy bonds, pension funds might buy bonds, local governments can issue bonds. So C is the correct answer. A bond issued by a city would most likely be classified as which of the following? This is not a supranational bond. Supranational bonds are issued by organizations like the World Bank and IMF. Quasi-government bonds are bonds issued by government agencies, so this is not the right answer. Non-sovereign government bond, that is the correct answer. A bond issued by a city or a state or a municipal authority would be a non-sovereign government bond. A fixed income security issued with a maturity at issuance of 9 months is most likely classified as what of the following? We've seen this before. If a security has a maturity of greater than 1 year, then it will be classified as a capital market security. Less than 1 year means that it would be classified as a money market security. Securitized investments are investments where we create a pool of assets and securities are issued against that pool. The price of a bond issued in the United States by a British company and denominated in US dollars is most likely to change as US interest rates change, British interest rates change, unaffected by interest rates. Since this is denominated in US dollars, it is going to be impacted by US interest rates. So the best answer is A. Interbank offer rates are best described as the rates at which major banks can issue short-term debt, borrow unsecured funds from other major banks, or borrow from other major banks against some form of collateral. If you remember the definition we saw, interbank offered rates are the rates at which banks can borrow from each other and the funds are unsecured. A company issues floating rate bonds. The coupon rate is expressed as 3-month LIBOR plus a spread. The coupon payments are most likely to increase as LIBOR increases, spread increases, company's credit quality decreases. The correct answer is A. As LIBOR increases, the coupon payment will increase. The coupon payment is equal to the coupon rate multiplied by the principal amount. The coupon rate is LIBOR plus a fixed spread. That spread might be 0.5%. So a change in LIBOR will cause the coupon payment to increase. The spread doesn't change in terms of the definition of the coupon rate here. Fixed income indices. This topic is covered in detail in another part of the curriculum where there is a full reading on security market indices, but here we will just cover a few basic points. A fixed income index is a multi-purpose tool used by investors and investment managers to describe a given bond market or sector, as well as to evaluate the performance of investments and investment managers. As indicated in this definition, we generally have an index based on the market or a sector that is being measured. So, for example, we can have an index which is based on all corporate bonds in a given country. There are many different indices, and the index construction varies across indices. By index construction, we mean the security selection. So what are the securities which will be part of the index, and then the weighting scheme. Again, discussion on the weighting scheme can be found in the reading on security market indices. We have a few aggregate bond market indices. The most famous one is the Barclays Capital Global Aggregate Bond Index. This aggregate index can then have multiple components. That is all we really need to worry about at this stage. Investors in fixed income securities. So far we have mostly focused on the supply side, which means who issues bonds. On this slide we talk about the demand side, or who are the players that invest in fixed income securities. The major category of bond investors include central banks, institutional investors, and retail investors. As you can imagine, the larger players are the banks or the central banks here and institutional investors. Central banks and institutional investors generally invest directly. Retail investors generally invest through mutual funds and exchange traded funds. Central banks use open market operations to implement monetary policy, and we've seen this in detail in economics, where central banks purchase bonds to increase the monetary base, and here we are talking about the bonds in a given country, so the domestic bonds. Or the central bank could sell bonds and reduce the monetary base. Institutional investors are the largest group of investors in fixed income securities. And institutional investors would be pension funds, for example, or sovereign funds. Retail investors are smaller investors, and they also invest in fixed income securities. Retail investors like the price and income stability that they get with fixed income securities. And this price and income stability is relative to the equity markets. One reason why institutional investors have a much bigger role to play in fixed income securities is that this is a fairly complicated market. For most companies, there will just be one type of share outstanding. Whereas for a given company like General Electric, there will be several different categories of bonds. If you take the government sector, there are a host of different kinds of bonds. So there is a lot of information that needs to be processed in order to make fixed income investments. And that is why institutional investors have a larger role to play relative to retail investors. And that also explains why retail investors generally don't invest directly in fixed income securities. Let's take a look at example 2 now. Open market operations describe the process used by central banks to buy and sell bonds to implement fiscal policy. That's not true. It's used to control the monetary base, and we just talked about that. Retail investors most likely do not invest in fixed income. That's not true. Invest in fixed income directly. That's also not true. Invest in fixed income indirectly through mutual funds or exchange traded funds, and that is true.